Welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast for today is from our transfer pricing series, and we will be focusing on Southeast Asia. In our agenda, we will briefly touch on the guidance on the transfer pricing under COVID-19 issued by the OECD in December of 2020. The guidance outlines the transfer pricing implications of COVID-19 pandemic. This guidance focuses on how the arm's length principle, as well as the OECD Transfer Pricing Guidelines, may apply to issues that may arise in the context of COVID-19. Our Southeast Asia transfer pricing partners will discuss how the tax authorities in their respective jurisdictions may treat COVID-19 losses and costs and grants, and may view the recommendations of the OECD on comparability. This topic has been discussed in numerous webinars, so for today, to differentiate ourselves, we will be using case studies to illustrate how the tax authorities in Southeast Asia will treat a common set of issues arising in these jurisdictions. Moreover, towards the end of our webcast, we will provide an update on the changing regulatory environment in the different countries. During the lockdowns, we have seen significant changes in the regulations in these countries. My name is Carlo Navarro. I am Deloitte Southeast Asia's transfer pricing partner, and I have the pleasure of hosting today's webcast. Today, I am accompanied by 5 esteemed transfer pricing partners representing the different countries in Southeast Asia. We have Shivaji Das, a transfer pricing partner who will cover Indonesia; Shubrata Dasgupta, our national transfer pricing leader for Malaysia; Avik Bose, a transfer pricing partner from our Singapore office; Stuart Simon, the national transfer pricing leader from Thailand; and Han Din Mai, the national transfer pricing leader of Vietnam. You may access each of our bios on the left-hand side of the screen. Before I go further into the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom of the right-hand screen. We'll do our best to respond to your questions during the presentation. Otherwise, we will get back to you shortly after the presentation. Second, all PC users can maximize and minimize each box at your convenience during the webcast. You may explore the icons at the bottom of the screen. If you want to download today's webcast slides and related publications, please go to the Downloads and Links box. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. And now, on for our topic today. In today's session, we will explore how the OECD guidance will be interpreted by the tax authorities in Southeast Asia. Since the issuance of the guidance by the OECD, none of the countries except for Singapore has issued a government-specific guidance. Having said that, our transfer pricing partners this afternoon will help us navigate the question of how COVID-19 losses, costs, and grants will be allocated based on their country's existing rules and experiences. To refresh our memory, the guidance issued by the OECD has 4 chapters. Chapter 1 deals with the issues related to comparability. Since current data has not taken into account the impact of the pandemic, the OECD in this chapter has recommended sources of information and approaches that may be relied on to estimate the impact of the pandemic. In this webinar, we will focus on chapters 2 and 3. Chapter 2 provides guidance on the allocation of COVID-19 losses and costs. This topic is more relevant to limited risk entities whose profitability has been kept stable through the years. Thus, the question arises on whether these limited risk entities can bear losses arising from the COVID-19 pandemic. And in this regard, the OECD reiterates 2 important principles. First, it says in paragraph 40 of the guidance that the allocation of losses and COVID-19 costs must follow the allocation of risk within the M&E group. Second, paragraph 48 of the guidance states that the party assuming the risk is the party who has control over such risk. In today's session, we will look at how these twin principles are accepted or interpreted by the C taxation authorities. Chapter 3 discusses the issues relating to the treatment of government grants. And the OECD recognizes that these grants may have an impact on pricing, thus we need to consider how such benefit should be treated for transfer pricing purposes. Should it be considered in the calculation of the profitability of the recipients, or should the M&E group benefit from such grant? Then Chapter 4 talks about how the changes brought about by the pandemic can impact the conditions contained in existing APAs. We will now proceed to examine the application of guidance provided in Chapters 2 and 3. Today, we have prepared 3 case studies. Using these case studies, we will try to illustrate how the guidance in Chapters 2 and 3 may be applied. In the first 2 case studies, we will show how the assumption of risks affects the allocation of COVID-19 losses or costs. And in the last case, we will cover the issues relating to grants. To aid us in our discussion today, we have chosen to examine the principal model, which we have seen often in Southeast Asia. And to refresh our memory just a bit, this model involves a principal and the limited risk entities. Each entity in the model bears specific risks. And these limited risk entities are your contract manufacturers and your limited risk distributors. And using this model, we will show how the losses may be allocated based on the assumption of risks. In the diagram on screen, you will see that the principal performs the entrepreneurial functions of sales and marketing, among others. It is therefore responsible for identifying customers, building market demand, and determination of the prices. Consequently, it bears significant market risks. In other words, any fluctuation in demand is the responsibility of the principal. On the other hand, the contract manufacturer on screen is responsible for manufacturing the goods based on the purchase orders and forecasts provided by the principal. It is therefore indirectly affected by market risk. The contract manufacturer is responsible for ensuring that its operations continue efficiently during the lockdowns imposed by the government. It therefore bears operational risks. Limited risk distributors on screen, on the other hand, are responsible for identifying customers and sales channels and for the distribution of goods locally. It is also responsible for ensuring that the goods are delivered during the lockdown. It therefore bears some level of market risk and high levels of operational risks. Now, let us go to our first case study. In our first case study, we will look at the issue of how losses due to the decline in the demand will be allocated between the principal and the limited risk entities. Decline in demand is a manifestation of market risks, which we saw materialize during the lockdown. On screen, we will note that the contract manufacturers and limited risk distributors' sales dropped by almost half from 2019 to 2020. This drop is attributable to the principal's inability to carry out its sales and marketing functions. While there is a drop in the variable cost of these entities, its fixed costs remain the same. Thus, the entities recorded losses in 2020 in contrast to a very stable profitability before the pandemic. The question that we have for our panelists this afternoon is, under your country's rules and practices, who should bear the 2020 loss? And in what instances should the principal or the LREs bear losses? And how will the TP adjustments be carried out in your country? Let's start with Avik to share with us the point of view from Singapore. Avik?
Thank you, Carlo. Let me first address your initial question on dealing with the losses. In Singapore, as you had mentioned earlier, the IRS has issued guidance on dealing with losses incurred by limited risk entities. To your question here, the primary approach we would ideally adopt in Singapore would be to first identify how much of the fixed costs incurred was routine in nature. That is, any fixed costs incurred specifically for the pandemic, like medical equipment and supplies, assistance to employees, like traveling or accommodation, any related retrenchment costs, etc., would be treated as non-routine. And the non-routine costs have to be dealt with and analyzed separately, and we shall discuss this later. Focusing on the routine fixed costs, we would ideally analyze all the relevant business risks, of which the important one is in question shall be the market risk. Considering the contract manufacturer, assuming that the contract manufacturing facilities are wholly at the disposal of the related party principal, and the contract manufacturer do not provide manufacturing services to any other related parties, ideally all the market risks should be borne by the principal. And therefore, the routine unabsorbed fixed costs due to fall in market demand should ideally be compensated by the principal. Now, in relation to the LRDs, the IRS has clearly stated that analysis of the market risk and inventory risk is important. In case the LRD bears market risk, then ideally unabsorbed routine fixed costs emanating from lack of sales should be borne by the LRD. Again, in a case where the LRD is not exposed to inventory risk, any losses, costs emanating from materialization of inventory risk, for example, expiration of products having very short shelf life, could be borne by the principal. Therefore, where the LRD is not exposed to any major risk, ideally the LRD should not bear any losses, meaning that those unabsorbed routine fixed costs may be borne by the principal. Of course, all relevant analysis should be included, and a robust TP documentation needs to be put in place to support your position or whatever position we take. Coming to your question on the possible adjustments, there are two potential categories of adjustments. One, adjustments to the results of the taxpayer, that is the entity itself. And second, adjustments to the benchmarking analysis or results of the comparable companies. Possible adjustments to financials of the taxpayer may include capacity utilization adjustments, primarily relevant for limited risk entities. Another adjustment could be to draw up a but for COVID-19 scenario by analyzing the variance between budgets and actuals in the past and applying this to the FY 2020 budgeted results, where I've had but for COVID numbers, which may help quantify impact of market risks to some extent. Talking about adjustments on comparable companies, it is particularly helpful in determining the arm's length markup under impact of COVID. The IRS in their guidelines has accepted the use of regression and variance analysis using GDP of respective countries as an indication to build in the impact of COVID-19 on the results of comparable companies. We would also undertake recourse to this adjustment wherever necessary. So how about you, Shubha? How will Malaysia treat this matter?
Thanks, Avik. And a very good afternoon to all the participants. Unlike Singapore, Malaysia has not released any formal guidance on TP impacts of COVID-19. However, being an inclusive framework member, it is expected that Malaysia would adopt some of the positions in the consensus document released by OECD. Coming to the first question which Carlo posted as to who should bear the loss, Para 39 of the OECD document has an interesting interpretation of Para 364 of the 2017 OECD TPG to say that low-risk entities may incur losses in the short run. However, in practice, the IRB is not receptive to this idea. In this specific fact pattern, IRB would first evaluate who bears the market risk and attribute the associated loss to that party. In the case of a Malaysian contract manufacturer, the foreign principal would generally bear this loss, while in the case of a Malaysian limited risk distributor that bears some marketplace risk, IRB may be receptive to a loss, which again is consistent with Para 40 of the OECD document. Coming to the second question which Carlo posted on what TP adjustments would be admissible, based on our conversations so far with the IRB, they are generally receptive to the examples of contemporaneous documentation and analysis in Para 11 of the OECD document, so long as these are taxpayer specific and not broad-based industry or geography data. IRB would also look at the profit or the loss in the entire supply chain. Looking at it from the taxpayer's perspective, they would likely have three options, combination of the three. Option one, make quantitative adjustments or analysis, such as the regression or the variance analysis, as mentioned in para 11, or a but-for analysis, as mentioned in para 12 of the OECD document. Option two would involve documenting qualitative explanation, including evidence of renegotiation with third-party suppliers and customers on sharing of loss or repricing of transactions. Interestingly, we had a similar case in the consumer durables business that was impacted by some external factors a couple of years back, for which we were able to collate and document similar evidence for audit by the IRB. The third option, and more of a natural recourse for taxpayers, would be to look at the updated year-on-year data on local comparables in due course, since the IRB generally accepts single-year loss comparables. This also finds support in para 33 of the OECD document. That would be Malaysia's position, or likely position, if I may put it that way. So I'll pass it to Shivaji to share what would be the perspective of Indonesia.
Yeah, thank you, Shubho. Firstly, I just wanted to start out by saying that the Indonesian Tax Authority is generally of the opinion that limited risk entities should not incur losses and should rather earn stable profits on a year-on-year basis. However, the IT acknowledges the impact that this pandemic has caused to businesses and would want to, consider those who are genuinely impacted. It will basically require the taxpayers to document and evidence the negative impact of this pandemic at the industry, supply chain, and group level. Now, in regard to the approach, although the ITA will refer to the discussions around risk allocation provided by OECD, in practice, the starting point for the ITA would be the legal agreements and the previous transfer pricing documentations to analyze the allocation of functions and risk between the parties in a pre-COVID period. Now, based on that, if it is found that historically the market risk has been with the principal, then the IT would expect the principal to bear the excess cost. And this position wouldn't change much between the contract manufacturer and the LRD unless it can be proved otherwise. Now, in the current case, it seems that the entity undertaking the sales and marketing functions and assuming the market risk is the principal. This is a very typical case where we find the key decision-making people sits with the principal in Singapore, and it's the principal who would assume the key risk and would also have the control over the risk, while the contract manufacturer would conduct manufacturing processes purely based on job orders and solely on behalf of the principal. So in this case, the ITA would view that the unabsorbed fixed cost is a result of the materialization of the market risk, and therefore, should pass on the cost to the principal. Now, as far as LRD is concerned, the fact-checking analysis needs to be done to understand if it really assumes any of the market or inventory risk that has materialized during this time. This is in line with what OECD has mentioned in para 38 and para 40 of its COVID. It's about going beyond the nomenclature of LRD and digging further to understand the facts, right? So to that extent, if the LRD indeed performs some market risk, then there may be grounds to say that the loss should be attributed to the limited risk distributor. However, as OECD points out, one needs to be mindful that the positions that are taken in the pre and post-pandemic times are consistent, because otherwise it is highly likely that those would be challenged by the tax authorities. In terms of Carlos' second question on the adjustments, it is quite clear that the entity who is ultimately bearing the cost has to explain the impact of the pandemic and also quantify the risk as part of a special factor analysis in the TP report. Now, there could be several approaches to this, as Avik and Shubho has alluded to earlier, so I'll not get into that, but probably the most pertinent in this case would be to perform economic adjustment, such as those of capacity utilization and working capital. Okay, with that, I'll pass it on to Han.
Thank you, Sivaji. Good afternoon, everyone. Same with Malaysia and Indonesia. Up to date, Vietnam has yet issued any official guidance for COVID-19 for taxpayer. So I would share my opinion based on current regulations and practical experience, as well as verbal discussion with tax officers so far. For this case, if the principal bears losses, then no issue from Vietnam side definitely. The taxpayers are considered to be in a very favorable position to tax authorities' view in Vietnam. If not, the most crucial is how to prove the situation of the limited risk entities along with their relevant market risks among taxpayers in Vietnam and principal. Tax authority would ask why limited risk companies record and have to bear the losses. Is this due to COVID-19 in reality or not? Therefore, it is required to analyze reason for the losses due to the COVID-19 factors and quantify such factors where appropriate. Another issue is that tax authority might pay attention to consistent treatment among the group. Whether or not the same treatment within MNC group is applied, tax officer could ask about the group policy in detail in this regard. Thus, taxpayer can utilize this being one of the evidence to defend. Concerning to the second question of Carlo about TP adjustment, in Vietnam, share with you that even before COVID-19, tax authority challenged any transfer pricing adjustment, either in the books and local file of the contract manufacturers and limited risk distributor. On top of that, tax authority always review reliabilities as well as accuracies of sources used to conduct TP adjustment. In addition, Vietnam tax offices would carefully check comparable companies in case of transfer pricing adjustment are made for the targeted. So whether or not it is applied similar approach for the comparable companies. Having said that, although Vietnam regulation allows to select comparable companies with established outside Vietnam, tax authority prefer selection of local comparable companies in Vietnam with a same economy, and they would easily to check the sources and review the financial data. Our TP regulation don't mention about rejection of loss comparable. So as long as appropriate write-up is documented, limited risk enterprises may include loss independent company in the final set of the comparable companies. So that is for Vietnam. So how about Thailand, Stuart?
Thank you, Han, and hello, everybody. For Thailand, I think some of the similar considerations that have already been discussed for some of the countries would be relevant. Thailand, similar to some of the other countries, has not issued any guidance on COVID for transfer pricing, but it is a member of the all-inclusive OECD framework for BEPS, and the OECD guidance should be instructive. Interestingly, based on our recent discussions with the Thai Revenue Department senior officers, they don't seem to have been given a lot of thought to this guidance as of yet, but I think that's probably due to the fact that a lot of the TP reviews currently underway are still focused on years before 2019. As low-risk entities, the starting point would be really that those entities should not bear the brunt of the impact of the loss of profitability in the supply chain. But there may be a recognition that it is possible that they may suffer reduced profitability or even losses in the short term. But this obviously would need to be consistent with the specific risks and types of costs which the Thai entity bears. I think it's important that the relevant agreements be considered. In the case of a contract manufacturer or a limited risk distributor, it's not uncommon to see target profit levels specified. And so unless there's amendments to the agreements put in place, the Thai Revenue Department will insist on these levels of profitability being maintained. So in terms of a decline in demand, which arguably the contract manufacturer and the limited risk distributor do not have control over, as it's related to the market risk, the principal should take on any associated costs. Now, in terms of the costs that should be borne by the principal, obviously this would need to be determined based on a matching of the specific risks borne by the principal versus the contract manufacturer and limited risk distributor. So if in this case we're focusing on market risk through the reduction in the demand, then I think that would translate into ensuring that the costs associated with underutilization, which might be focused on the fixed costs in the contract manufacturer and limited risk distributor, are covered by the principal. In terms of whether that compensation should be marked up, I think the prime sort of consideration there is really the arm's length range based on the Thai comparable companies, and whether the contract manufacturer or limited risk distributor falls within the range after the compensation. That's it for Thailand. Over to you, to Carlo for the Philippines.
Right, thanks, Stuart. So just like the other countries, the Philippines has not issued any guidance on the treatment of COVID-19 costs and losses. And similar to the positions taken by the other countries, the Philippines will also allocate the loss and cost based on the assumption of risks, risk assumed by the LREs, right? Because the Philippine regulations are highly dependent and largely based on the OECD guidelines. Now, in the case of BAR, since market risk is a risk attached to sales and marketing functions, then the entity that performs these functions will have to bear the consequences of the market risk. And in the contract manufacturing model, the principal is the one responsible for these functions and risks. Thus, any losses sustained for the failure to undertake the sales and marketing functions and to manage market risk should be borne by the principal. And to answer one of the questions there, to what extent will that loss be passed to the principal? The answer there is that the full unabsorbed variable and fixed cost will have to be charged back to the principal plus a markup, right? So there should be no loss in the Philippines, and it will be all those variable and the unabsorbed fixed costs will have to be charged to the principal. Is there a way to mitigate that loss that will be passed back to the principal? Of course there is. If there are unabsorbed variable costs incurred due to the inefficiency created by the contract manufacturer, that should be retained by the CM. Thus, part of that loss attributable to these inefficiencies may be retained in the books of the contract manufacturer. I'll deal with the other question on whether we can use that CUP, the sale of the principal to third parties CUP later on. Similarly, in a limited risk model, LRDs can have sales functions. If the loss came from the inability of the LRD to execute sales and cover its fixed cost and variable cost, the loss in this case, therefore, may be sustained by the LRD. One approach to estimate how much of that loss should be borne by the LRD is to look at the difference between the LRD's sales targets and its actual sales. Then the cost proportionate to that unmet sales target cannot be passed on to the principal and therefore should be borne by the LRD. And if the costs are to be passed on to the principal, the question is whether it should be subject to the same markup charged prior to the pandemic. And the answer here will depend on the profitability levels of the comparable companies. In the Philippine regulations, the rejection of loss-making countries are mandated, but it is possible to develop an argument that we should accept loss-making companies in the context of COVID-19. Now that wraps up our first case study. And now we will move to the second case study for this afternoon. In our next case study, we will be dealing with the issue of relating to operational risk, right? So this is second risk that we would like to look at. And in this case study, the LREs in the different countries in Southeast Asia were affected by the different lockdowns imposed by their respective governments. Thus, the limited risk entities were temporarily not able to produce and sell the goods. Furthermore, the limited risk entities also incurred COVID-19 related costs in order for them to continue their operation. This includes obtaining accommodation and transportation for their people so that they can report to the office or the factory. The question we pose to our speakers is who will bear the loss arising from the failure to operate during the lockdowns? And in what instances will the principal and the LREs be responsible for such losses? Lastly, who should bear those COVID-19 related costs? So let's hear from Avik first on, to respond to these questions.
Thanks, Carlo. So when we are talking about the operational risks and costs related to this risk, it will be important to first estimate the related expenses and associated losses. And this necessitates some adjustments to the results of the taxpayer, that is the entity itself. Going back to my earlier discussion, we should first identify the routine unabsorbed fixed costs and the non-routine unabsorbed fixed costs. And talking about the variable costs, all the variable costs are most likely to be routine variable costs, that is related to normal business operations. Once this segregation has been done, considering the routine expenses and taking up the case of the contract manufacturer first, we can think of undertaking a but for COVID capacity utilization adjustment by looking at the variance between the past budgeted versus actual results and apply this variance on, say, the financial year 2020 budgeted results to draw up an expected actual but for COVID-19 result. This result would help us in estimating two things. One, the normal or the routine unutilized capacity of the contract manufacturer, if any. That is, the unutilized capacity had COVID-19 not impacted. This analysis will also help us to estimate the non-routine unutilized capacity of the contract manufacturer. That is, unutilized capacity due to impact of COVID-19 market risk. The actual operating costs, both variable and fixed, related or incurred in relation to the non-routine unutilized capacity would be attributed to lack or fall in demand due to COVID-19 and may be borne by the principal in Singapore, including the arm's length markup. The actual costs related to routine unutilized capacity is usually reimbursed by the principal without any markup, given no manufacturing functions were undertaken here. Now, coming to the LRD, as discussed before, initial classification between routine and non-routine expenses should be undertaken, and then in relation to the routine operating expenses, depending on the functional analysis, if the LRD is not exposed to any risk, the LRD should be compensated for these actual costs along with an arm's length operating margin. Turning to the non-routine expenses incurred specifically for COVID-19, one needs to analyze whether the principal has sanctioned or budgeted and approved these costs, or whether the decision on incurring these costs were undertaken independently by the contract manufacturer or the limited risk distributor. In the former scenario, these costs could be compensated without any markup by the principal because the principal took a decision to undertake or incur these expenses. While in the latter case, IRS may challenge such costs being picked up by the principal. Also, in case some of these non-routine costs are expected to be incurred on a routine basis in future, these costs could be treated as part of the normal operating expenses. But sufficient explanation needs to be provided in the TP report to support this stand. Now, coming to the topic of losses emanating specifically from lockdown of operations. In Singapore, our approach in dealing with losses emanating from lockdowns depend on whether these lockdowns have been under strict direction of the local government or whether the lockdown decision was taken by the principal as a measure of abundant precaution for the safety of the employees. That is not a government-mandated lockdown. Or was the decision for lockdown taken independently by the local management without directions from the group? For the first and the third scenario, where the lockdowns were enforced due to government restrictions or due to local management decisions, the principal should not ideally compensate the contract manufacturer or the limited risk entities for the costs, losses incurred, since the lockdowns were not under direct control or direction of the principal. In the case where the principal directed closure of the facilities, the principal should ideally bear the costs, but there should ideally be no markup, given that no additional functions were undertaken by the limited risk entities during the lockdown. It's just a reimbursement of the costs. One should also be mindful of the term testing for tested party results allowed by IRS for financial year 2020 and 2021, which I'll discuss later. In case application of term testing results in an arm's length outcome, then specific adjustments for lockdowns may not be necessary. With this, I'll pass over to Shubho, who will be talking from a Malaysian perspective again. Over to you, Shubho.
Thanks, Avik. So as we can see, the loss may be arising from inability to produce or sell due to mandatory closure of business. B, additional exceptional costs, or C, a combination of these two. In either case, it would again boil down to the risk allocation based on accurate delineation of transactions. Where the loss is arising from a local government action, it may be possible to attribute this loss to the Malaysian low-risk entity. However, if the loss is arising from the action of the principal, it would invariably flow back to the principal. Now, coming to the second question on what TP adjustments would be admissible in this case, since the IRB uses local comparables and year-on-year data in audit, there would be two probable scenarios that I can think of. One is comparables faced the same lockdown. Under those circumstances, IRB may just use the comparables data as is and may not allow any specific adjustments. Scenario 2 is where the comparables did not face a similar lockdown, and the lockdown faced by the tested party was basically for a part of the year only. In that case, a carve-out of the income statement may be a viable option for local documentation purposes. Coming to the issue of additional exceptional costs, Para 49, Para 52, and Para 53 of the OECD document would be indicative of the likely position in audit. That is, a four-step approach needs to be followed. First, we need to assess whether these costs are indeed exceptional or they are related to some permanent change in the business or substitute costs. Assuming that the costs are indeed exceptional, step 2 would involve an assessment as to whether these costs are related to the control transactions. If they are not, then we can exclude it from the TP computation. If they are related to the control transaction, then we move to step 3, which will involve again an assessment of risk, right? And whosoever bears the risk that gives rise to these exceptional costs will be the party to whom the costs would be attributed. Now, assuming that ultimately it is determined that the principal should pick up these exceptional costs, in step 4, it will involve a discussion, and I would say more very likely a negotiation with the IRB as to whether these costs need to be passed back to the principal with or without a markup. In specific cases, IRB may be amenable to a reimbursement of costs only. I would also like to take this opportunity to draw attention of our participants to Para 58 of the OECD document, which provides an example in the context of force majeure that bears some resemblance to this specific case study that we are talking about, and hints at evaluating options realistically available to the parties. Based on our conversations with the IRB so far, options realistically available is also something that they will pay attention to. So that would likely be the Malaysia position. Over to you, Shivaji, for Indonesia.
Thank you, Shubho. You're talking about the COVID-related and lockdown cost. IT is likely to look at the specific facts of the case and also try to understand, the nature of the cost in terms of whether they are arising purely out of the lockdown/preventive measures imposed either by the local government or the principal, or is a result of the operational risk. Now, it would be necessary to isolate the impact of the pandemic on such cost, to analyze the portion of the cost attributed to operational risk versus the costs that are extraordinary in nature, and that arose purely because of the pandemic. Now, generally speaking, the portion of the cost attributed to operational risk should be borne by the contract manufacturer or LRD, as the case may be, while for the extraordinary expenses, we will have to undertake further analysis, to understand the specific facts as well as the functions and risk associated with those extraordinary costs. Now, as OECD recommends, we need to be mindful about the treatment of these exceptional costs. And this was something that Shubh was also mentioning, that these costs may not be exceptional or non-recurring anymore if they continue to be incurred in future. So it is advisable that when we review these extraordinary costs, we review it in a bit more detail than what we have been doing in the past. But again, this would again depend on several factors, including the duration of the pandemic, the broader effects of the pandemic on specific industries, and others. Now, talking about comparability analysis, we need to consider whether these exceptional costs need to be included or carved out from the PLI calculation. Certainly, these exceptional costs would need to be carved out if they are attributable to the local entities, whether it's a CM or an LRD. However, if these are attributable to the principal, then an important point to consider would be whether these should be included in the cost base and recharged with the profit element, or whether it should be treated as a pass-through cost. Now, assuming the limited risk entities are absorbing the losses and they're located in Indonesia, Indonesia follows an ex-ante approach, so one might consider testing the transfer pricing policies and budgets, but of course, with a view to compare the same with the actual ex-post result, and then document the reason for the deviation of the actual result from the budget. In situation where testing of the transfer pricing policy is not feasible, then we can look at certain economic adjustments to arrive at the real operating profits, which would necessitate isolating the impact of the pandemic. And these may include adjustments like capacity utilization, working capital, losses due to foreign exchange fluctuation, lockdown, and other extraordinary costs. Okay, with that, I'll pass on to Han for Vietnam.
Thank you, Sivaji. Due to operational disruption, contract manufacturers and limited risk distributors are temporarily not able to produce and sell the goods. They are those functions, so their losses may be attributed to them. In the absence of guidance for TP adjustment, technically, special factors adjustment could be made based on budget, capacity utilization, and operating costs. However, it bases on the specific case-by-case basis and tax office point of view. Talking about the budgeting, it is quite convenient for taxpayers to analyze the budget's bias actual. In this regard, the tax authority may not rely too much on budgeting since, in their view, this is only internal data which taxpayer is able to prepare and adjust. One of the common adjustments is capacity utilization. Accordingly, the fixed cost respective to underutilization might be excluded from the total cost. Nevertheless, the fact is that in case taxpayer in Vietnam make any adjustment for fixed costs from transfer pricing perspective, it also might incur a potential risk for corporate income tax. Therefore, it should be very mindful of this adjustment in Vietnam. With regard to additional variable costs incurred, there are two cases depends on who we bear the cost. In the case limited risk enterprises bear the cost, and if it is just COVID-19 related costs and one-off occurring for the specific period, such costs could be considered excluded from calculation of the profit level indicators. As per degrees 132, comparable should be year-on-year data as well. So the taxpayer should analyze such adjustment of the selected comparable companies. In the case, such additional exceptional costs borne by the principal and limited risk distributor would pass the cost to the principal without a markup, which is considered as reimbursement only. So this is for Vietnam. So now I pass to Stuart to share about Thailand.
Thanks, Dan. Again, I think similar principles discussed for some of the other countries would apply in Thailand. And to the extent that operational risks are borne by the contract manufacturer or limited risk distributor, then the cost should be borne by those entities. In terms of adjustments, we do have some precedent in Thailand going back to the 2010 floods, which caused a number of companies to shut down their operations for a certain period of time. And in that case, the Revenue Department allowed the period impacted by the closure to be removed from the analysis. But the assumption here was that the comparable companies did not have a similar impact. In COVID times, I think it'd be more necessary to assess whether the comparable companies also experienced a lockdown. There haven't, however, been uniform lockdowns across Thailand during COVID. In terms of reduced operating efficiency after the lockdown, it may be possible to make adjustments to the Thai entity to reflect the underutilization where the costs are under the control of the Thai entity, whether it's the contract manufacturer or the limited risk distributor. For example, employee costs, where the Thai entity has control over those costs. But again, the situation for the comparable companies would need to be considered. Extraordinary COVID-related costs may also be adjusted for through special factor analysis. But as mentioned by some of the other countries, care needs to be taken in classifying one-off costs versus sort of ongoing, continuing costs which become a normal part of operations. With that, over to Carlo for the Philippines.
Thanks, Stuart. I think the Philippine position will be similar to what most of the countries have said so far, right? I think at this point, the question in our audience is that to what extent should that loss be borne by the limited risk entity, right? We have to note that the losses sustained in this case was due to the lockdowns imposed by the government, and the LRD and the contract manufacturer failed to distribute the goods and to manufacture the goods, right? So how do we approach, and how much is that loss should be booked in the books of the contract manufacturer and LRD? There are multiple approaches that we can take here. With respect to this contract manufacturer, one approach that we can do is we can estimate the impact of the lockdown by examining its capacity utilization. For instance, if the CM is only 70% utilized out of its normal capacity, we can argue that 30% of that fixed cost may be excluded from the cost base subject to a markup. And to that extent, that 30% unabsorbed fixed cost will be the extent of the loss that should be booked in the books of the contract manufacturer. With respect to the LRD, one approach that I can think of right now is to estimate the impact of the lockdown is to use the sales budget or target. We can either add back the difference between the sales target and actual sales to estimate what would have been the sales if it were not for the lockdown. Or we can remove the percentage of fixed cost that is proportionate to the unmet sales target. And if after doing that, if the LRD's profitability is within the arm's length range, we can argue that that entire loss is solely due to the failure of the LRD to meet its sales target. Thus, the loss can be retained in the LRD's books, right? So I hope that gives you an insight on how those, to what extent will the loss be sustained by these entities. Now, moving on to our third case study, which concerns the treatment of government grants. In this case study, we are assuming that the local government has granted wage subsidies to the local entities for them to keep their employees. And certainly, the subsidies will have an impact on the financials of these entities. It will reduce the actual cost incurred by these entities. The questions that we have for our panelists are, how will the subsidies be treated for transfer pricing purposes? Should it be considered in the calculation of the PLI for local purposes? Should the principal benefit from such wage subsidies? Will the principal be not required to true up the profitability of the local entity if the latter's margin falls within the arm's length range after considering the subsidy? These grants are prevalent in Indonesia, Malaysia, and Singapore. Hence, we will only be asking Avik, Shubho, and Shivaji to share their views on this point. Avik?
Thanks, Carlo. Regarding government assistance in Singapore, this primarily relates to Job Support Scheme or JSS payouts. And we all know IRS has a specific guidance issued on how to deal with JSS payouts. These payouts are treated by IRS as conditions of the local market, that is specific to Singapore. And by default, these benefits are to be retained by the taxpayers in Singapore. What this means is that where an entity is operating under a cost-plus model, government grants should not be used to reduce the total cost, and markup should instead be applied on the full total operating expense as usual. Similarly, for a limited risk distributor operating in Singapore, government grants are not considered as part of revenue or profit. Only in case where the taxpayers are able to show reliable evidence that these benefits are passed on to third parties, or third parties are passing on these benefits to their customers, example by way of price reduction, IRS may allow taxpayers to similarly pass on the benefits to their related parties, but this has to be adequately documented. That's the position in Singapore. So over to you, Shubho, from a Malaysian perspective.
Thanks, Avik. And very similar. See, generally, federal government grants are not taxable, right, as income. And besides, like any COVID-specific support provided by the government is to help local businesses. So it is very unlikely that the IRB would be amenable to pass on this benefit to the foreign principal, either through offset against the cost base in case of a contract manufacturer, or by way of recognition as an other operating income for a limited risk distributor when we are computing TP margins. So that's very likely the position for Malaysia. I'll pass it to Shivaji for Indonesia.
Thanks, Shubho. I think in relation to the government grant, there needs to be a holistic approach to analyze the grants provided. And that would basically include the terms and conditions of these programs, and then determining the effect of these programs on related party transaction, and also in terms of whether the support is temporary or ongoing in nature. Now, the issue is that for local tax authorities, depending on the accounting treatment, this government grant can have the effect of reducing the cost base. And this may potentially result in a lower charge to the principal. And this is especially true when we're talking about limited risk entities, right, who are more often than not based on a fully loaded cost plus arrangement. Now, in such a situation, the ITA would likely argue that these are local market features, and therefore the benefits provided by the Indonesian government should be retained locally. Now, in line with that, the ITA would expect these grants to be accounted or credited separately into the profit and loss account, and not taken part of the cost base that would be marked up by the principal. Since the ITA follows the ATO quite closely, I think it is worth mentioning that the ATO also seems to have taken a similar position in one of the guidance provided, that the Australian entities should retain the benefits of the JobKeeper payment that was granted by the Australian government to help keep Australians in the job. Back to you, Carlo.
Thank you, partners, for sharing your views with respect to government grants. We're running out of time, so when we wanted to make sure that our participants this afternoon would know the latest developments that are happening on the ground. Partners, I'm passing it to you, Shivaji, for an update in Indonesia.
Yes, thank you, Carlo. I think I'll just briefly talk about 3 key points here, because we have covered most of the other points through the cases. So firstly, just to reiterate that Indonesia has not released any COVID-specific guidance on transfer pricing matters yet, except for APA, which is worth looking at. But it is likely that the OECD guidance will be referred to, considering that Indonesia is a G20 member country and is one of the 137 members of the inclusive framework that has provided consensus to this COVID-19 guidance by the OECD. The second point that I want to mention is when we talk about losses and allocation of the COVID-19 specific cost, like we discussed earlier, that ITA would definitely refer to the existing contractual arrangements and past year transfer pricing reports, and those would form the starting point for determining, the allocation of risk and losses between the parties. However, that being said, the COVID-19 situation has resulted in circumstances that go well and truly beyond what was reasonably anticipated in an intergroup arrangement, and therefore these circumstances would need to be identified and then quantified, right? And that would be sort of the defense for the transfer pricing issue, the limited risk entities are incurring losses in the local jurisdiction. Lastly, on the update, as I was mentioning earlier, the ITA has issued a revised guidance on APA in 2020. And this is primarily with a view to align with the broader objectives of Action 14 to ensure greater legal certainty to taxpayer. But then it also provided an update in October of 2020 that basically talks about the COVID-19 impact on taxpayers. And in that guidance, it basically requests taxpayers to isolate the impact of the pandemic from the projected financial statement. There are in fact templates provided in the regulation that will require the taxpayer to show the changes in revenue and expenses of the P&L account, and also provide explanation for any variances resulting from COVID-19, such that it can be aligned with the COVID-19 or pre-COVID situation, right? So, that guidance on APA is quite critical, so it might be worth having a look. But for now, I'll just pass on to you, Shubho.
Thanks, Shivaji. On the Malaysia front, based on our conversation as recent as 2 days back, IRB is looking at releasing COVID-specific guidance, but that is not a top priority for now because they are currently auditing up to the year of assessment 2019. Now, in terms of their interpretation and position on the existing OECD document, again, based on informal conversations, what we understand is that they may allow the use of term test, but on a very selective basis. They will continue to insist on local comparables, especially considering para 32, 83, and 84 of the OECD document, which seem to favor the use of local comparables. They have also indicated that a strong emphasis would be put on documentation around internal communications and decision-making processes on COVID risk mitigation measures. This is to analyze assumption of risk. Coming to losses and allocation of COVID-19 specific costs, taxpayers are advised to close their books based on prudent business judgment with regard to TP margins. And in case these margins eventually fall short of the comparables, taxpayers are encouraged to avail the voluntary disclosure route, which can result in a much lower surcharge. In terms of APA, in summary, the negotiations on existing cases as well as any application for new cases will only be entertained if these are from businesses which are not impacted by COVID. Now, there have been 3 landmark changes in law which are effective from 1st of January 2021. And these kind of also set the tone for scrutiny going forward, including COVID-impacted years. The first change is the introduction of a flat penalty of ringgit 20,000 to 100,000 per year of assessment for failing to furnish TP report upon request. This is to re-emphasize the importance of TP report, especially to defend COVID impact justifications, among others. The second change is the introduction of a surcharge of up to 5% of TP adjustment. This is to stimulate arm's length behavior among taxpayers with tax attributes. For example, those who are enjoying incentives or a preferential tax rate, as well as those who have unabsorbed carry-forward business losses. The last change is the fortification of the power to disregard and recharacterize the structure of controlled transactions. While the primary targets would likely be structures which lack substance, as well as intercompany loans in certain cases, the business restructurings induced by COVID would also come under the purview of this specific change. So with that, I will pass it to Carlo to share about the changes in Philippines. Over to you, Carlo.
Thanks, Shubho. So over the last year, we have seen around 8 regulations, transfer pricing regulations passed by the BIR, right? So I will touch only on the important ones right now. The first one is on the TP disclosure form that is required to be submitted by the BIR for all taxpayers that meet certain thresholds. So you need to check if you meet those thresholds and you will be required to submit those disclosure forms. The disclosure forms will be used by the BIR to make an assessment on which taxpayer will be audited for transfer pricing purposes. And if you pass the threshold to submit the disclosure form, you will now need to assess whether you have passed the threshold to prepare a transfer pricing documentation. So two important things. Now, if you look at that regulation passed by the BIR on the disclosure form and risk assessment, it will already indicate which areas they are going to focus on when they start auditing. The first one would be loss-making companies and those companies that have transacted with loss-making companies. Second are those companies that have significant tax incentives and those companies that have transacted with these companies with tax incentives. And the third one are large taxpayers and their related parties of transactions with these large taxpayers. That's all I need to update on regarding the Philippines. So I will now pass you on to Stuart.
Thanks, Carlo. In Thailand, Thailand's formal TP laws were effective for the first year in accounting period starting on or after 1st of January 2019. Prior to that, there was informal guidance, and that would basically follow the pre-BEPS OECD guidance. One of the key issues or challenges we faced in Thailand in recent years has been the fact that there are no supporting guidance for a number of the transfer pricing laws, and we're still waiting for clarification on significant aspects to be provided, and that includes the contents of the local file, master file lodgement requirement, and CBCR requirements. The most recent supporting regulation was issued a couple of months ago in the form of Director General Notification 400. And this actually covered a wide range of areas, including acceptable transfer pricing methods and comparability analysis, transfer pricing adjustments, services, intellectual property, and corresponding and secondary adjustments and APAs. I'll just go through quickly some of the more interesting aspects of the rules. Now, the TP methods provided are basically in line with the 5 OECD methods. Now, where companies use another method, not one of the 5 methods, then they will need to provide an explanatory letter to the Revenue Department in the first year of use for their consideration. In terms of transfer pricing adjustments, where the tested parties' results are outside of the range, there's no specific point indicated within the range to which the adjustment will be made. But there is just an indication that the adjustment should be made to an appropriate point based on the circumstances. So clearly, quite a bit of room for negotiation with the Revenue Department there. One of the common questions we get asked in Thailand is, do we really need to use a Thai benchmarking set? And the quick answer there is that yes, as of today, it's still necessary for a Thai tested party to prepare a Thai benchmarking set, because the Thai Revenue Department has a very strong preference for Thai comparables. They, as yet, do not have access to global regional databases. There is an exception, of course, and that's where the tested party is outside of Thailand. And the Thai Revenue Department will obviously allow regional or global comparables to be used in those cases. In terms of transfer pricing audits, we've seen a significant increase in action during the last few months with invitation letters issued to a number of companies. And there's been a significant increase in the number of audits being performed. Interestingly, I think, though, the periods subject to review are focused on periods prior to the new TP laws, so before 2019. With that, I think it's to Avik.
Thanks, Stuart. So in Singapore, the developments primarily relate to the issue of COVID-19 related guidance by the IRS. IRS is amongst the very few tax authorities that have come out with specific local TP guidelines relating to COVID. The initial guidance was issued in September 2020, followed by an update on 29 January 2021, and are largely consistent with OECD guidelines. The various key considerations discussed in these guidelines are listed on the right side of the screen, and for the sake of time, and I'll just focus on the issues relating to testing and inclusion of loss makers in the comparable set. So coming to the term testing, usually in Singapore, IRS will compare 1-year tested party results versus 3-year comparable company weighted average data. In case taxpayers intend to use, say, 3-year tested party data instead of 1 year, a prior approval had to be sought from IRS. Only under exceptional circumstances, IRS would allow. However, for financial year 2020 and 2021, IRS has allowed taxpayers to use 3-year tested party data, which is like the weighted average, to compare with the 3 years comparable company data without asking for a prior approval from IRS. The use of 3-year tested party data may benefit taxpayers by averaging out the returns over a 3-year period, and if by doing so the results fall within the benchmark arm's length range, taxpayer results for 2020 or 2021 will be considered to be within arm's length range from a Singapore perspective, even if on a standalone basis, say, they would have fallen below the range. So point to be noted, this is only allowed for financial year 2020 and 2021. The next important issue is inclusion of loss makers. So on the topic of inclusion of loss makers, comparable companies in the benchmarking set, the usual practice of IRS was to reject consistent loss makers in the set by excluding comparables that had losses in more than half of the tested period, or the comparables had a weighted average loss on an overall basis. However, taxpayers may include loss makers in the set for testing results for financial years impacted by COVID, in case the comparables too have incurred losses during the COVID-19 impacted years and were otherwise not consistent loss makers in the prior periods, that is, periods not impacted by COVID-19. So these are the two additional components that were discussed in the COVID-19 guidelines specified by IRS, which are not there in the OECD guidelines. So with that, I'll pass over to An.
Thank you, Avik. For Vietnam, to date, there is no formal guidance issued by the authorities. The tax collection KPI for 2021 has reduced a bit compared with the previous year. Nevertheless, the tax authorities still have very aggressive plans to tax audit inspection based on 2 key perspectives. First one is the selection of the risk assessment system. Tax authorities maintain a software system with more than 20 criteria based on the audited FS and annual tax return in selection of the taxpayer being audited. Taxpayers are ranked by risk level being high, medium, and low risk. Second one is the topic-based selection include, for example, transfer pricing, corporate income tax incentive, and tax refund. They also focus on targeted industries such as retail, e-commerce, and real estate. During the allocation of losses among the group entities, at this stage, Vietnam has not released any formal guidance from the authorities yet. Meanwhile, for TP compliance requirement, which is applied from 2020 tax year, new decrees 132 even provide more burden for the taxpayer when increased lower quota from 25% as previously to 35%. We don't have any specific program targeted intergroup transaction. The programs are mostly aimed at supporting the corporate at the company-wide level. Last update about notable changes proposed in the draft APA circular. First change in the period of the application is reduced from 5 years as current circular to 3 years. Another critical proposal is effectiveness of APA application. It may be interpreted from APA is approved. Current circular is from official submissions of APA dossier. With that, I over back to you, Carlo.
Thank you, partners, and ladies and gentlemen. That is all what we have time for today. Avik Shubho, Shivaji, Stuart Han, thank you for today's presentation, and thanks to all of you who were able to join us. We would like to encourage you to fill out a short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. And if you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit our Deloitte Debriefs website. We will respond to all the questions submitted during the webcast soon. Also, if you think of any other questions or comments later, please feel free to reach out either to myself or our speakers. Happy to talk to you. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast for today. Goodbye.